Close your eyes and picture this. The most powerful man in the world is not in the Oval Office. He's not in a war room. He's at a shuttered, moonlit summer camp, surrounded by a handful of exhausted aides, a single telex machine, and a ticking clock. In less than 48 hours, he will sign a single-page document. He will not call his allies. He will not inform Congress. He will make a unilateral decision that, in one weekend, will sever the global financial system from 5,000 years of economic reality. What you think you know about money, value, and debt is a story built on the ashes of that weekend. Welcome to the real story of the Nixon shock. This is not a history lesson. This is a forensic audit of the moment the dollar divorced gold, and we all inherited the consequences. Before the divorce, there was the marriage, a seemingly stable, global arrangement forged in the ashes of World War II at Bretton Woods. Every major currency was pegged to the US dollar, and the US dollar was, by solemn treaty, convertible into gold at $35 an ounce. This was the bedrock. This was the rule of law for global finance. It imposed discipline. If a country spent too much, gold would flee its reserves, forcing austerity. For the US, it was a double-edged sword of exorbitant privilege and profound constraint. The system promised stability, but beneath the polished surface, tectonic stresses were building. The Vietnam War, the Great Society programs, America was printing dollars to pay for them, and the world was accumulating them, waiting to exchange paper for hard metal. This Bretton Woods system was a grand bargain, American economic dominance in exchange for monetary discipline. But by the late 1960s, that discipline was cracking. The U.S. gold stock had plummeted from its post-war peak of over $20 billion to just $10 billion, while foreign-held dollar claims had ballooned to over $40 billion. The math was simple and terrifying. America did not have enough gold to back the dollars in circulation abroad. The system was functionally bankrupt, sustained only by faith and geopolitical pressure. The rule-based world was a facade, and key players in Europe knew it. They began to ask uncomfortable questions, setting the stage for a confrontation that would shatter the illusion of permanent stability and expose the fragile fiction at the heart of global finance. The first major crack appeared not from a rival superpower, but from a resurgent ally, France. Under the shrewd and economically nationalist President Charles de Gaulle, France launched a direct assault on American monetary hegemony. De Gaulle, advised by the formidable economist Jacques Rueff, understood the inherent asymmetry of the Bretton Woods system. He famously denounced America's exorbitant privilege, the ability to run vast trade deficits and fund global ambitions simply by printing the world's reserve currency. Beginning in 1965, de Gaulle put theory into practice. He ordered the French treasury to systematically convert its growing dollar reserves into physical gold, demanding shipment from the vaults of the New York Federal Reserve to the Bank of France. This was not a quiet financial transaction. It was a geopolitical statement, broadcast to the world. France was calling America's bluff. Other nations, notably West Germany, watched nervously, some following suit in smaller measures. The image of U.S. Air Force transport planes loaded with gold bars flying across the Atlantic became a powerful symbol of American vulnerability. Each flight physically diminished Fort Knox and publicly undermined confidence in the dollar's promise. This run on gold exposed the central contradiction. The U.S. needed the dollar to be abundant to fuel global trade and its own spending, but that very abundance destroyed the confidence required for its convertibility. The French gambit proved that the gold window was not a sacred trust, but a liability. It transformed a simmering economic problem into a full-blown crisis of credibility, forcing Nixon's administration to confront an inevitable, painful choice: defend the system and face brutal deflation, or close the window and unleash an unknown monetary future. The stage was set for a secret weekend that would change everything. As the gold drain accelerated through 1971, a small, secretive group within the Nixon administration began planning for the unthinkable. This was not the official Treasury Department or the Federal Reserve's Open Market Committee. Those institutions were bound by orthodoxy and diplomacy. This was an ad hoc crisis cabinet, led by the pragmatic and politically attuned Treasury Secretary John Connally. Connally, a former governor of Texas, brought a blunt, confrontational style to the quiet world of central banking. His inner circle included Undersecretary for Monetary Affairs Paul Volcker, the towering, intellectually rigorous economist who understood the international system's plumbing, and a handful of trusted aides like Treasury General Counsel Peter Peterson. Their meetings were cloaked in secrecy, their memos stamped with extreme classification. They operated under a shared, grim conclusion. The current path was unsustainable. The official U.S. position, championed by Arthur Burns at the Federal Reserve, was one of pleading for time and negotiating voluntary restraint with allies. Connolly's group saw this as denial. They began drafting contingency plans with clinical names like Plan X, which centered on the unilateral suspension of gold convertibility. Their analysis was brutally logical. The U.S. held most of the leverage. The world was drowning in dollars. What would other countries do if the tap was suddenly shut off? The planning was as much about political narrative as economic shock. They knew the decision would be seen as a betrayal of treaty obligations. Their task was to frame it not as a failure, but as a necessary defense, an act of strength to force a new economic policy on America's terms. This cadre of decision-makers insulated Nixon from the cautious bureaucracy, preparing the legal, rhetorical, and logistical groundwork for a financial coup. They were preparing to break the world to save America's position within it. On Friday, August 13, 1971, President Richard Nixon, along with his core crisis team, Connally, Volcker, Burns, Peterson, and a few others, vanished from public view. The cover story was a routine weekend meeting at the presidential retreat, Camp David. In reality, they were entering a financial war room. The setting was surreal. The rustic cabins of a mountain retreat, now strewn with economic charts, legal pads, and the constant clatter of a secure teletype linking them to Washington. For 2 days, this isolated group debated the fate of the global monetary system. The discussions were tense, even acrimonious. Federal Reserve Chairman Arthur Burns, the old guard defender of Bretton Woods, made a desperate, last-minute plea for incrementalism, warning of catastrophic global panic and the end of American credibility. John Connally, in what would become a legendary performance, bulldozed the objections. He framed the suspension of gold convertibility not as a retreat, but as a bold offensive move, a necessary shock to force America's trading partners, particularly Japan and West Germany, to revalue their currencies and share the burden of adjustment. Paul Volcker provided the technical scaffolding, outlining the precise mechanisms and immediate steps. The debate crystallized around a single, stark choice: slow, negotiated decline with dwindling gold, or a sudden, controlled explosion that reset the board. By Sunday evening, the decision was made. They would close the gold window. But Connally insisted the move couldn't stand alone. It had to be packaged as part of a sweeping new economic policy for domestic consumption. Hence the addition of a 90-day wage and price freeze and a 10% import surcharge. The secret weekend was over. They had drafted history in the Maryland woods. All that remained was to announce to a sleeping world that the rules had just been rewritten. On the evening of Sunday, August 15, 1971, at 9 p.m. Eastern Time, President Richard Nixon appeared on television screens across America. Sitting solemnly behind the Oval Office desk, he addressed the nation not about Vietnam or civil unrest, but about the complex, arcane world of international finance. The speech, titled The Challenge of Peace, was a masterpiece of political framing, crafted to sell a technical financial default as a patriotic act of renewal. He began by invoking the guns and butter burdens of war and domestic programs, setting up a narrative of unfair global competition. Then came the pivot. I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold or other reserve assets. The core promise of Bretton Woods was revoked in a single sentence. But Nixon immediately wrapped this radical act in the language of strength and protection. He announced the 90-day wage and price freeze to stop the rise in the cost of living, and the 10% import surcharge to protect American jobs. The message was clear. America was under attack from freeloading allies, and these were defensive, pro-worker measures. The complex, systemic failure of U.S. monetary policy was repackaged as a tough negotiation tactic to force other nations to play fair. The financial world was stunned. Trading floors in Asia and Europe opened to chaos. Central bankers scrambled for clarification, Their primary reserve asset was now a floating abstraction. For the average American viewer, the details were obscure, but the tone was resonant. A president taking charge, defending the nation. In one speech, Nixon successfully detached the dollar from gold and, just as crucially, detached the political narrative from the economic reality, selling the end of an era as the beginning of a bold new chapter. As the sun rose on Monday, August 16, 1971, the global financial system experienced a coordinated heart attack. Trading floors from Tokyo to London erupted in panic. The foreign exchange markets, built on fixed parities to the dollar, simply stopped. There were no prices. The anchor of the system had been cut loose, and the ship was spinning in a void. Currency traders, with no benchmark for value, refused to quote rates. The dollar was now an undefined quantity. Bond markets swooned on fears of uncontrolled inflation. Gold markets, now theoretically free from their $35 shackle, surged in London and Zurich, but trading was thin and frantic. Central bankers were on the phone constantly, their lines buzzing with a mixture of outrage, fear, and frantic calculation. Japanese officials were reportedly in a state of shock, facing the imminent devastation of their export-driven economy from the U.S. import surcharge. In Europe, the reaction was one of profound betrayal. The U.S. had acted unilaterally, without consultation, breaking a fundamental treaty. The immediate economic aftermath was a paradoxical freeze. Global trade, reliant on known currency values, seized up. The Nixon administration's desired effect, forcing allies to the negotiating table, was achieved instantly, but through brute force trauma, not diplomacy. The weekend's secret decision had, within 24 hours, created the first modern global currency crisis. It was a world without a monetary compass, a vivid demonstration of what happens when the foundational promise of the financial system is suddenly, irrevocably broken. The age of certainty was over. The age of volatility, speculation, and fiat money had begun with a single, terrifying Monday. In the rubble of the fixed-rate system, a new, uncertain reality emerged, the era of fiat money. Fiat is derived from the Latin for "let it be done." A fiat currency has value not because it is backed by a physical commodity like gold, but solely by government decree and, ultimately, collective faith. Nixon's decision didn't just suspend gold convertibility. It forced the world's major currencies to float. This meant their relative values would no longer be set by treaty, but by the hourly verdict of the foreign exchange market, a daily plebiscite driven by trade flows, interest rate differentials, speculation, and sentiment. This was a philosophical earthquake. For centuries, the idea of money was tied to something tangible. Now, value was abstract, psychological, and incredibly volatile. Proponents, like many of Nixon's advisors, argued this allowed for necessary economic adjustments. Countries could devalue their currencies to boost exports without a painful deflationary spiral. Critics saw Pandora's box opened. Without the external discipline of gold, governments were free to print money to finance deficits, inviting inflation. The dollar, now untethered, was free to become a truly global tool, a T-bill standard, where the world ran on the promise of future U.S. tax revenue. The birth of fiat fundamentally shifted power from external constraint to internal policy. It made central bankers, not gold mines, the arbiters of value. It unleashed unprecedented levels of global capital mobility and speculation. The Nixon shock was the midwife to this new world, where money was no longer a physical fact, but a fragile, dynamic consensus. A consensus that could be created, manipulated, and, as future crises would show, shattered with terrifying speed. The initial freedom from gold constraints seemed liberating, but it soon birthed a monster, the great inflation of the 1970s. Unleashed from the discipline of convertibility and battered by oil price shocks, the U.S. Federal Reserve under Arthur Burns allowed the money supply to expand rapidly. The result was stagflation, a debilitating combination of high unemployment and soaring prices that defied traditional economic models. By the late 1970s, faith in the dollar and in fiat money itself was crumbling. The man tasked with saving the system was Paul Volcker, the very same undersecretary who helped plan the Camp David retreat, now appointed chairman of the Fed by President Carter in 1979. Volcker understood the stark truth. To save fiat money, he had to impose a discipline even more brutal than the gold standard. He declared war on inflation, not through wage and price controls, but by violently constricting the money supply, allowing the federal funds rate to soar past 20%. The medicine was agonizing: a severe recession, skyrocketing unemployment, and bankruptcies across industries from agriculture to manufacturing. It was political poison. But Volcker, operating with iron conviction, held the course. His policy was a stark demonstration of the new rules of the fiat era. Stability would not come from a physical anchor, but from the credible, often painful, actions of an independent central bank. By the mid-1980s, inflation was broken. Volcker's success legitimized the post-1971 system. It proved that fiat money could work, but only under the vigilant, ruthless stewardship of technocrats willing to inflict short-term pain for long-term stability. The Volcker shock was the necessary, brutal sequel to the Nixon shock, the moment the new system proved it could survive its own inherent temptations. With gold gone, the global system needed a new mechanism to create demand for dollars and prevent a freefall. The ingenious, albeit informal, solution emerged from the chaos of the 1973 oil crisis. In a series of secret diplomatic and financial understandings between the U.S., Saudi Arabia, and eventually OPEC, a new deal was struck. The United States would provide military protection and arms to the oil-rich Gulf monarchies. In return, these nations would price their oil exclusively in U.S. dollars and recycle their massive dollar earnings, petrodollars, back into U.S. Treasury bonds and Wall Street assets. This was the birth of the petrodollar system. It was a de facto re-anchoring of global trade, not to a metal, but to the most essential commodity of the industrial age, oil. Every nation needing oil now needed a steady supply of dollars, ensuring perpetual global demand for the U.S. currency regardless of trade deficits. This system solved the dollar glut problem by creating a circular flow. Dollars went out to pay for oil, and petrodollars flowed back to finance the U.S. government and its deficits. It cemented dollar hegemony far more powerfully than Bretton Woods ever had, as it was backed by tangible energy needs, not just treaty promises. The petrodollar created a hidden subsidy for the U.S., allowing it to run persistent, twin deficits, trade and budget, while enjoying low interest rates. It was the masterstroke that transformed Nixon's defensive act of breaking the system into an offensive tool of unparalleled financial dominance, tying the fate of the global economy and energy markets inextricably to the health of the U.S. dollar and treasury. The floating currency regime and petrodollar recycling unleashed a tidal wave of stateless capital. This eurodollar market, dollars held outside U.S. banking regulation, ballooned. Freed from the volatility-dampening anchor of gold, currency values fluctuated wildly, creating a perfect ecosystem for a new industry: currency speculation. What was once a staid function for facilitating trade became a high-stakes casino. The 1970s and 80s saw the rise of legendary forex traders like George Soros, who could bet billions against central banks. Financial derivatives, futures, options, and swaps exploded in complexity and volume, designed to hedge or speculate on this new volatility. This financialization accelerated the shift of economic power from industrial production to Wall Street trading desks. The sheer volume of capital sloshing around the globe in search of yield far outstripped the needs of the real economy. It led to massive asset bubbles, from Japanese real estate in the 80s to dot-com stocks in the 90s. The post-1971 world didn't just change money. It changed capitalism's center of gravity. The real economy of manufacturing and wages grew increasingly disconnected from the financial economy of asset prices and currency trades. The permanent decoupling of the dollar from reality didn't just create floating exchange rates. It created a floating, hyperliquid, and often predatory global financial system where betting on money itself became the most lucrative game in town, with consequences for stability that we are still grappling with today. The new monetary system, while creating vast financial wealth, operated as a powerful, silent engine of wealth redistribution. The mechanisms were complex but devastatingly effective. First, inflation, a frequent feature of the fiat era, acts as a hidden tax on cash savings and fixed incomes, eroding the purchasing power of the middle and working classes. Those who own hard assets, real estate, stocks, commodities, see their values rise with inflation, protecting and growing their wealth. Second, the financialization boom disproportionately benefited the top echelons who had capital to invest in the new casino of markets and derivatives. Third, and most critically, the system of persistent low interest rates following crises, like 2008, became a primary tool for stabilization. This easy money policy, involving quantitative easing, QE, inflated asset prices, stocks, bonds, real estate, to extraordinary levels. Since asset ownership is heavily concentrated among the wealthiest 10%, this directly and massively increased their net worth, while wages for the majority stagnated. The ability of governments and central banks to create money ex nihilo after 1971 fundamentally altered the relationship between capital and labor. Capital, being mobile and financial, could access and benefit from new money creation instantly. Labor could not. Thus, the post-gold system intended to provide policy flexibility inadvertently built a structural bias into the global economy. It systematically transferred economic resilience and growth away from wage earners and towards asset holders, creating the vast wealth inequality that defines the 21st century. The ultimate test of the post-1971 financial architecture came in 2008. The crisis was a direct child of the system's features: global imbalances, hyperfinancialization, reckless credit creation, and a speculative mania in real estate, an asset class made bubbly by easy money. When the subprime mortgage bubble burst, it threatened to collapse the entire shadow banking system of derivatives and leverage, a system that had grown to multiples of global GDP. This was the moment of truth. With no gold standard to limit the response, what would the authorities do? The answer was an unprecedented, all-out intervention that proved the fiat system's core operational principle. In a crisis, it would not be constrained by physical scarcity, but only by political will. Today, we live in the world forged that weekend in 1971, a world of permanent, active monetary management. The divorce from reality is now the operating system. Central banks are no longer passive guardians of a gold peg. They are the most powerful actors in the global economy, constantly manipulating the price of money, interest rates, and its quantity, balance sheets, to manage growth, employment, and financial stability. The market is not truly free. It is Fed put, or ECB put, underpinned by the expectation of central bank rescue. This has led to a staggering expansion of balance sheets, from a few hundred billion pre-2008 to nearly $9 trillion for the Fed alone post-pandemic. Government debt, once constrained by gold outflows, now balloons with only political limits, as central banks stand ready to monetize it. This system creates strange paradoxes. Money is abundant, yet it feels scarce for most people. Asset prices defy gravity, yet real economic growth is anemic. We have traded the external discipline of gold for the internal, often improvised, discipline of committees. The 1971 decision created a flexible tool that has prevented another Great Depression, but at the cost of chronic financial instability, extreme inequality, and an economy that is addicted to ever larger doses of cheap credit. This secret weekend didn't just end an era. It initiated a continuous, high-stakes experiment in which we are all unwilling subjects. The inherent flaws and perceived manipulations of the fiat system have catalyzed the most significant monetary rebellion since 1971, cryptocurrency. Bitcoin, created in the wake of the 2008 crisis, was explicitly designed as a response to the Nixon shock world. Its founding Genesis block famously contained the headline, "The Times 03/Jan/2009 Chancellor on brink of second bailout for banks." This was a declaration of war on the centralized, trust-based fiat model. Bitcoin proposed a new digital gold, a decentralized, scarce, capped at 21 million, programmable asset whose monetary policy is governed by immutable code, not fallible human committees. It promised a return to a rules-based system, but one that is cryptographic and global, not geopolitical. The explosion of Ethereum and other blockchains expands this into a vision of decentralized finance, DeFi, that operates outside traditional banking channels. While volatile and still evolving, the crypto movement represents a profound philosophical critique. that the 1971 divorce created a system too easily manipulated for political and elite benefit. Whether crypto succeeds or fails, its very existence is a direct symptom of the lingering distrust in the fiat order. It is the market's attempt, 50 years later, to engineer a new anchor, a new form of reality, from which value should not be decoupled. 50 years on, the legacy of that August weekend remains deeply unresolved. What was gained? Unprecedented policy flexibility. The ability for governments to fight recessions aggressively, fund large-scale social and military projects without immediate fiscal constraint, and avoid the brutal gold standard deflations of the past. It facilitated the explosive growth of global trade and complex financial markets. But what was lost? The loss of a neutral, external anchor removed a crucial check on political and financial excess. It replaced the discipline of a physical limit with the fallible discipline of technocrats and politicians, who are often incentivized to prioritize short-term stability over long-term health. We lost a shared, stable measuring stick for value, trading it for a world of relative, fluctuating prices, where wealth can be created or destroyed by central bank pronouncements. The divorce from gold was ultimately a divorce from objective scarcity. We gained the power to create limitless money, but in doing so, we may have destabilized the very concept of lasting value, fueled boom-bust cycles, and entrenched a system where financial assets inflate while real wages stall. The 1971 divorce didn't just decouple the dollar from metal, it decoupled economic outcomes from traditional effort and trust in institutions from tangible backing. We are still living in the long, uncertain aftermath of that secret weekend, navigating a world built on a promise that is only as strong as our collective and increasingly strained faith. So where does that leave us? The journey from the gold-backed certainty of Bretton Woods to the algorithm-driven volatility of today wasn't an accident of history. It was a deliberate choice, made in secret, over 48 hours in 1971. We've traced its path, from the panic on trading floors, to Volcker's brutal medicine, to the petrodollar deal, to the inequality engine and the digital rebellion of Bitcoin. One decision created the flexible, crisis-fighting tools of modern central banks, but also the speculative frenzies, the debt mountains, and the pervasive sense that the financial system is a rigged game detached from the realities of everyday work and value. The big idea is this: every dollar in your wallet, every price on a screen, every interest rate on a loan is a ghost of that system, a token in a vast, ongoing experiment in faith-based value. The divorce from gold was a leap into a world of pure narrative, where economics became a story we tell ourselves about confidence, power, and promises. If this deep dive into the foundational fracture of modern finance has changed how you see money, then the next chapter is even more critical. In our next investigation, we will expose the petrodollar lifeline, the secret 1974 pact that saved the dollar and enslaved the global economy. We'll unpack the exact meeting rooms, the handshake deals with Saudi royalty, and how the U.S. weaponized oil to create a permanent global demand for its currency, a system now facing its greatest threat. This is the hidden mechanism that made the post-1971 world work. To ensure you don't miss that revelation, make sure you are subscribed to Blood Money Files with notifications on. The real story of how power operates is just getting started.